Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. This was the week that we got some downbeat commentary from the Fed. The risks of higher unemployment and higher inflation have risen, and a trade deal, quote-unquote, of sorts between the U.S. and the U.K. The latter still has to be finalized, but the agreement in principle was delivered with great fanfare and was met with a healthy pop in the equity market. Or maybe the pop was attributable to the white smoke at the Vatican. Tough to say. A comment by a portfolio manager did catch my attention this week. When asked to sum up the environment, he described it this way. There is a 50% chance the Fed will not cut this year, and a 50% chance it cuts 200 to 300 basis points. Kind of sums it up pretty well. This week, our three things are: 1. Falling oil. Is it good or bad for credit? 2. Tariff impact. We'll highlight some useful commentary. And 3. Credit's appeal. How does credit stack up in this environment? All right, let's dig a bit deeper. Falling oil. One of the things we've learned over the decades is it's really hard or treacherous to predict oil prices. The commodity is largely produced by state-owned or affiliated enterprises that are, by their very nature, political. Decision-making is driven by forces that are not entirely economic. About 40% of the global production today comes from the Middle East and Russia. But when the price of oil falls 26% from a year ago, you have to think through the implications of that move. The price of a gallon of gasoline, $3.15, is 50 cents or 14% below the year-ago level. That adds up to the proverbial tax cut, albeit a modest one, to the American consumer, call it $20 a month or so, back into disposable income. Yes, it provides some relief to lower-income households and provides some offset to inflation elsewhere, but its overall effect is rather modest. To oil producers, it's painful. The current West Texas price of $58 a barrel sits below the break-even levels reported across all major U.S. drilling regions, which range from $61 to $70 a barrel, according to the Dallas Fed. Earnings expectations for the energy sector have come down hard as a result of the price pressure. With some 72% of companies in the S&P 500 reporting Q1 earnings, energy firms on average reported 14% lower EPS than the year-ago quarter. According to FactSet, at the sub-industry level, 4 of the 5 sub-industries in the sector are reporting year-over-year declines in earnings. Oil and gas refining and marketing, down 109%. Integrated oil and gas, down 14%. Oil and gas equipment and services, down 8%. And oil and gas storage and transportation, down 2%. On the other hand, the oil and gas exploration and production is the only sub-industry reporting year-over-year growth in earnings. For Q2 and full year 2025, equity analysts have cut their forecast for the sector, the total oil and gas sector, by 15%. In credit, investment-grade energy is now 35 basis points wide to the industrial index, up from 15 basis points a year ago. And with WTI forward prices only modestly higher, that's $66 by Q4, and growth slowing, things are not likely to materially improve anytime soon. That's not good for the oil and gas industry, which accounts for around 11 million jobs, or 5% of the total U.S. employment, and $1.8 trillion in GDP, and that's just under 7% of the U.S. total. So a bit of a mixed bag in terms of overall impact to the economy, but the direct hit to a meaningful industry and the signals sent that global growth is slowing leave us on the negative side of things in terms of impact to credit. All right, on to our second thing, tariff hits. So we've seen some interesting disclosure around the potential impact of tariffs. One thing that is commonly ignored in these calculations, in our opinion, is details around the forward look. Fed Chair Powell alluded to this lack of detail in his press conference this week, saying there is, quote, so much we don't know, unquote, about the tariff regime, including scale, scope, timing, and persistence. What assumptions are being made in forecasts? How severe is the hit to economic growth? For how long? How broad? We just don't know. That's the problem economic actors are facing. And that, of course, frustrates many market observers and participants that want proactive monetary policy response rather than something data-driven. But that's another story. In terms of disclosure, let's start with HSBC, the world's best trade finance bank, at least according to one trade publication. The bank disclosed the impact of what it calls a plausible downside tariff scenario, which assumes significant increases in tariffs, check, that would result in a notable slowdown, Still to be determined in global trade and a slowdown in GDP growth. All right, at least we've got some detail. Under that scenario, the hit to revenues is expected to be only low single digit. Modeling for loan losses shows an increase of $500 million above the base case, and those hits don't amount to much for a bank forecast to earn $32 billion pre-tax in 2025. Now, as we said, this guidance does factor in economic slowdown, so this really says more about the fact that HSBC doesn't take a lot of risk in its core business lines. Then there are companies such as United Airlines that have guided under two scenarios, stable and recessionary in United's case. This also takes into account the macro environment. Despite the fact that the company says its outlook is dependent on a macro environment which it believes is impossible to predict with any degree of confidence, it does predict earnings anyway, where the midpoints of its 2025 EPS estimates range from plus 18% to minus 25%, depending on the scenario. That's quite a gap. Bloomberg Intelligence has come out with sectoral views that factor in estimated tariff rates based on reviews of 275 companies. Consumer staples are facing, on average, a 51% hit to operating income absent any mitigating effects. Consumer discretionary at 42%, materials 39%, and technology 37% would also be materially hit. Healthcare and communications are the winners with less than a 2% impact. To offset tariff cost increases, firms producing materials would need to raise prices, in Bloomberg's estimation, by 19%, technology by 17%, consumer discretionary by 12%, and staples by mid-single digits. The combination there of higher costs and higher prices fit neatly into a stagflationary outcome. And that's not good for credit. All right, on to our third thing, the appeal of credit. In preparation for a presentation this week, we compiled total returns on a variety of asset classes since the election and compared those to the S&P 500. The results are telling. In an environment where stock valuations are clearly frothy and growth is set to slow, but not fall off a cliff, the appeal of credit's diversification and income grows. Since the election, U.S. public high yield has outperformed the S&P by 4.6%, while U.S. public investment grade has outperformed by 4.4%. A 60-40 portfolio modeled by BlackRock has outperformed the S&P by 2.6%. European public IG has outperformed by 3.6%, and European public high yield has outperformed by 3.9%. The risks to credit are inflation and/or recession. We saw the ravages of the Fed's rate hikes in 2022 on the asset class and are wary of sharp economic downturns when stock and credit correlations turn positive. But in an environment where growth is slowing but not expected to fall off a cliff, and where inflation is relatively well behaved, the two should go hand in hand, credit figures to remain in demand. Investors that can absorb illiquidity and complexity can do even better, with 200 to 300 basis point premia available via private credit and esoteric asset-backed securities. So there you have it. Three things in credit. 1, falling oil. A modest benefit to the consumer, but the hit to energy producers and the signal it sends on global growth is not a plus. 2, tariff impact. It's fluid, but at the end of the day, it's a tax, and the near-term effect is inflationary. And 3, credit appeal. Relative value, taking into account the benefits of income and diversification, remains strong in this environment. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research, including the first installments of our new series, The Forward Look, Credit Insights from, respectively, the US and from Europe and the UK. We'll see you next week.